Americans have a $35 trillion question on their hands.
U.S. government debt is now the highest in history.
Well, U.S. debt topping over $34 trillion for the first time ever.
The United States government debt has soared to unprecedented levels, nearly matching the peaks reached during World War II when military spending was at its highest. This figure, now exceeding $34 trillion, is continually rising. Experts predict that in 20 years, the debt could become unmanageable, potentially triggering a financial crisis in the world's largest economy. The critical question is how to escape this debt spiral and the consequences if we fail. To assess the extent of U.S. debt, we compare the total value of all goods and services produced annually, GDP, to the amount the government spends. Our current debt to GDP ratio is about 96%. To fund essentials like schools, roads, the military, social services like Medicare and Medicaid, Social Security, and even interest on debt, the government primarily relies on tax revenue from economic activities. When spending exceeds revenue, borrowing is necessary, driving up debt levels. This situation developed over time, starting in the early 2000s with increased spending on the Afghanistan and Iraq wars. During the 2008 financial crisis, market crashes, job losses, and reduced tax revenue accelerated debt growth. Subsequent spending programs expanded further, and the 2017 Tax Cuts and Jobs Act significantly reduced tax income. The COVID-19 pandemic required additional borrowing to finance relief efforts, exacerbating the imbalance between spending and income, leading to more borrowing and higher debt levels. Understanding who the U.S. borrows from is crucial. Unlike individuals who take loans from banks, the government raises funds by issuing and selling financial assets like bonds, notes, and treasuries on the open market. Large investors, businesses, and regular individuals all purchase these financial products, which are essentially promissory notes guaranteeing that the government will repay the borrowed money with interest, known as the return. These government bonds can be bought from the government, banks, and dealers, among other sources. Historically, these bonds have been considered a good investment due to the perceived strength and stability of the U.S. economy and currency. They are seen as a safe investment because investors are confident they will receive their capital back along with the promised interest. Although the yields or interest rates on these bonds are typically low, they provide a secure, low-risk way to earn money. However, the situation is becoming more complicated as U.S. debt continues to rise at an alarming rate. As the government borrows more, lenders are increasingly concerned about the sustainability of this debt. High levels of debt can lead to various economic issues, such as rising interest rates to attract buyers to government bonds, inflationary pressures, and concerns about the country's long-term fiscal health. When the U.S. government issues more promissory notes to borrow additional funds, it increases its debt obligations, causing investors to worry about the government's ability to manage its finances effectively. If doubts about the government's fiscal stability arise, investors might hesitate to lend money, especially if bond interest rates are low. To entice investors despite these concerns, the government may need to raise interest rates, offering higher returns to make government debt more attractive. This scenario adds complexity to financial markets as investors shift their money from riskier assets like stocks and student loans to safer options like government bonds. This shift in investment behavior can have broader implications for the entire economy. For example, when investors withdraw their money from riskier assets, the market for those assets declines, causing their prices to drop. Higher returns on government bonds might also prompt lenders to increase interest rates on consumer loans, such as mortgages and car loans, to attract investors and compensate for the higher risk of lending. Consequently, borrowing costs for individuals may rise, making it more expensive to finance major purchases like cars and homes. This can impact consumer spending, economic growth, and overall economic stability. According to a study conducted by the University of Pennsylvania, in 20 years, we may reach a point where borrowing money at current rates is unsustainable. The accrued interest on the government's debt will become so high that repayment will be impossible, akin to not paying a credit card bill due to an unmanageable interest rate. This scenario is often referred to as a credit bubble. How can we escape this predicament? One potential solution lies in an economic boom similar to the post-World War II era, when the US reduced military spending and the economy rapidly expanded, helping to lower the debt. Optimists believe that advancements in artificial intelligence could lead to increased productivity and economic growth, which might help us recover. However, many experts are skeptical. They argue that recovery is less likely this time, especially with the aging population, particularly baby boomers, which strains government budgets for social programs like Social Security and healthcare. As the debt grows and the need for funding increases, lawmakers may consider alternative revenue sources. One method is increasing the money supply through tools like quantitative easing or direct monetization of debt. While this might seem straightforward, it carries significant risks and potential negative economic consequences. Printing more money reduces the value of existing currency, diminishing its purchasing power. This oversupply of money relative to goods and services can lead to inflation, which lowers the real value of savings and income, making people and families poorer. Additionally, rising inflation can destabilize the economy, negatively affecting businesses, investors, and consumers alike.